Good evening and welcome to our virtual roundtable, Corporate Venture Capital, Does It Pay Off? Thank you for joining this session. My name is Mark Ziegler. I'm Senior Partner at Porsche Consulting and Head of our Digital Transformation Practice, and very pleased to be your moderator. Innovation has been very high on the management agenda for many, many years across all industries and across all markets. And since the innovation output of purely internal innovation activities is rather incremental for many companies, more and more organizations increasingly also rely on cooperations with startups, for example, through CVC investments. We at Porsche Consulting have had the opportunity to support many different clients in setting up such partnerships, and I'm therefore quite excited to share our experience, but even more to hear about the in-depth recommendations of our today's panelists. So what can we expect from this roundtable concretely? A deep understanding of the performance implications of corporate venture capital. Second, practical insights from the operational side based on our own CVC unit, Porsche Ventures, as well as other renowned entities. And lastly, insights about current market conditions and critical success factors when engaging in the CVC game. We will get started with an inspiring impulse from my colleague, Dr. Christopher Coolins. Christopher is the head of our innovation lab, advising clients on improving their innovation activities, and he has also dealt with the performance implications of CVCs in his doctoral thesis. And following the lecture, we will then directly jump into the panel. That being said, I appreciate to have you, Christopher, and we are looking forward to your short impulse.
Thank you very much. So let's kick it off straight away. 10 minutes, 3 perspectives from my end. So first of all, as corporate venture capital normally doesn't happen in a vacuum, we will explore a little bit how CVC is embedded into the overall innovation architecture at Porsche. Second, we will deal with the question, did it pay off for Porsche? So what were the performance implications on financial and strategic KPIs? And then we will move away from the Porsche context, answering the question, did it pay off also for other companies operating in different industries? That being said, let's have a closer look on the Porsche innovation system. Typically, as in line with many similar companies out there, it was for decades with a very internal innovation focus. So internal concepts, internal R&D activities, maybe some collaborations with other entities within the Volkswagen Group. A very famous vehicle internally named as Win on Sunday, Sell on Monday. Go for extreme contexts like the racing industry, developed for this very demanding customers over there, and then transfer it back to mass market production. So results would be the light-weight composites or turbocharged engines. This very closed innovation system worked comparatively well for Porsche for decades, because from a very high-level perspective, you could argue that the customer needs within the segment stayed stable for a comparatively large amount of time. So we are talking about faster cars that are fun to drive, reliable and safe, maybe adding a brand component to it. What we experienced in the last years, and this is not only unique to the automotive context, but many others. First of all, we will experience an disruptive technology shift from combustion engines to electrified vehicles. Then the typical characteristics of the car get less and less important. When you look to China, for instance, a key willingness to pay driver these days are the entertainment functions of the car, which are quite of a stretch for classical automotive manufacturers to compete on. And we see an increasing importance of shared and connected mobility needs and services. Against this changing landscape, Porsche decided to add to the classical innovation system. So this traditional components still are in place. So Win on Sunday, Sell on Monday, now in the Formula E, for instance, developing for this highly demanding context there, and then bringing it to the Taycan, for instance. but on the right side, you see vehicles to correspond more to this disruptive change that's taking place. So we have Porsche Digital focusing on the development of digital products and services. We have APX, for instance, investing in external business model ideas. And the focus for today, corporate venture capital invests here with the example of Porsche Ventures investing in future technologies. And there I would like to make a deep dive in. So on the left side here, you see the operational components of Porsche Ventures. So more than 40 direct investments in the typical investment range between 3 to 4 million in clearly defined investment areas. This give a kind of scope to the unit, a strong global footprint in major tech hubs. We're talking about Tel Aviv, Palo Alto, or Berlin, for instance, and direct visibility at sea level. What I would like to highlight in particular, we're talking about the comparatively small number of employees. So 17 team members responsible to achieve the goals on the right side. So to get a grasp on new innovation, technology, in crafting new partnerships with interesting companies to allow beyond the core growth. Then second, as Porsche Ventures should carry itself also a very ambitious financial goal for the unit, and then add innovation and technology to the corporate growth story of Porsche overall. Obviously, then the question arises, did Porsche achieved this ambitious goal with the CVC unit? And from my perspective, the answer is a clear yes. Here you see some examples we brought to the table for today. So on the very left side, we have Rimac, a company that is operating in the e-vehicle context, providing high-performance solutions in the context of batteries or e-axis, for instance. A first CVC investment took place in 2018, and meanwhile, it went to the very strong strategic partnership with a joint venture with Bugatti and the vision to transform Rimac into a tier one supplier for Porsche and other automotive suppliers or automotive manufacturers as well. Second, a highlight in the middle, 1,5 grad. So a company focusing to provide climate-neutral energy technologies into the B2C context. So as a house owner, you can buy the wall box to charge your electronic vehicles and also the installation services to attach it to your wall. And this also is a good example of the Porsche investment strategy, because obviously if you do something for the charging infrastructure in Germany, it hopefully helps to develop the e-vehicle market overall. The Porsche with its models is very active as well. From the combined perspective, you see here at the very bottom, so very attractive evaluations. We're talking about 2 unicorn investments, suppose with a market evaluation above 1 billion euro. So you can have an estimate that's also from financial perspective, it's paying off for Porsche. On the right side, some argumentation to see the impact on the corporate growth story. And there, our very famous 17 employees come back onto stage. So this unit, the Porsche Venture unit, was the only one with direct presence at the recent Capital Market Day. And this is remarkable because we're talking about a unit with 17 employees in an organization with more than 34,000 employees overall, the only unit with direct presence at the Capital Market Day. And also, maybe Patrick will talk about it later on. It was now the announcement that Porsche Venture is going to grow further. All right, let's leave the Porsche context for a bit and move to the question, is Porsche a singular case, or can the insights be transferred to other industries, to other companies as well? And the answer, again, is a clear yes. So CVC investments can create value for every firm. How we back up this argumentation? So recently, there was an attempt to combine every available corporate venture capital data into one massive data set. So we're talking about more than 100,000 CVC transactions, and analyzing this super large data set, the question has been answered quite clearly. CVC can create value for every firm, and we see an impact in 3 different dimensions. So the first one, strategy. So the promise of stimulating new products and stimulate alliance formation holds true. Also, the promise from a technology perspective to increase patent output or R&D input holds true. And last but not least, also you can see a clear financial impact on classical numbers like Turbin's Q or revenue. Obviously, you can go even one level deeper and crunch the numbers concerning success factors. So what came out, for instance, don't do it alone, do it in co-investments with independent VCs. Why? Because you see more and better deals and you learn about state-of-the-art investment practices. Also, you want to design clear collaborative blueprints. So how exactly does the knowledge transfer between startup and corporate is taking place? Which frequency? Who is responsible? Many other success factors we probably are going to discuss within the panel. That being said, back to you, Mark.
Yeah, thank you very much, Christoph, for these insights. I think they serve as a kind of nice foundation for our upcoming panel discussion. Before we jump into the discussion, let me introduce you to our today's panelists first, as they are. Patrick Hucke. Patrick is head of Porsche Ventures and head of business development and partnering at Porsche Digital. And prior to his current role, Patrick held different positions at Porsche, being with the company for more than 10 years. As head of Porsche Ventures, he's directly involved in crafting the investment strategy at Porsche Ventures, and was very close to Porsche's well-known, as we have heard, investment in 1,5 Grad, one of the newest tech unicorns in the European energy industry. And then there is Luise Gruner. Luise is managing director of Axel Springer Digital Ventures, the corporate venture capital arm of Axel Springer, where she is focused on investing in early stage companies as well as in other venture capital funds. And before that, she built up the Axel Springer Plug and Play Accelerator with more than 100 portfolio companies. Next on stage will also be Jörg Reinbold. Jörg also has triple-digit transaction experience through his time as managing director of APX and his current position as general partner at the Hartfeld Fund. And Jörg also sits on the board of Balsen and has extensive experience in ensuring the knowledge transfer between startup and corporate. And last but not least, Shihan Şükür. Shihan is head of corporate development and strategy at MHP, our sister company. And not only since his MBA thesis on the transformation from a strategic-driven towards a financial-driven corporate venture capital unit, Shihan is deeply connected to the topic of today, but also with profound experience in consulting clients in the fields of CVC. Again, it is a pleasure to have you in our roundtable today, and I'm very much looking forward to our, hopefully for all of you, interesting discussion. One more advice to all our participants now in front of the screen. If there is any question, please do not hesitate to use the chat function. My colleagues will take care of your questions during the roundtable. I'm delighted to introduce you to the first topic of our discussion, how to start the CVC game. We will now get started to discuss for whom CVC investments are suitable for, what advantages and also disadvantages exist compared to other innovation vehicles, and above all, how to start the game. Therefore, the first question is directed to Patrick. Christopher touched upon it in his little speech, but can you take us back to the details of the process of setting up a CVC unit at Porsche, and what factors were weighted against each other in the course of the decision?
Yeah, sure. Thanks, Mark, and yeah, thanks for having me. Happy to take you back to the first days of Porsche Ventures. So when we started our venture capital activities at Porsche in 2016, 2017, we were very aware that the automotive industry was facing huge technological changes like the digital transformation, which we wanted to address both through internal skills, but also through external innovation and access to new technologies, new partners. So accordingly, for us at Porsche, it was not a matter of weighing up factors, but rather the realization, I would say, that we will continue to further develop our own strength, while at the same time creating space to integrate additional external innovation in order to achieve the best results at the end.
And after the decision in favor of the CVC vehicle was made by the Porsche board, what were the single steps to bring the topic to life?
Yeah, so I would say the first steps of Porsche Ventures were very similar to the entrepreneurial founding of a startup. So we thought very carefully in advance about what our vision, mission, and goals are or would be at Porsche Ventures. Of course, strongly derived from the Porsche strategy. And we then continuously attracted the best talent in the relevant technology hubs worldwide. So a good mix of Porsche colleagues and at the same time talent from the technology industry, from startups and venture capital firms who then complemented the team in order to then make the first and initial investments on behalf of Porsche Ventures, and also to build our brand, obviously, in the venture capital industry. At the same time, we also cooperated with partners. You mentioned it before, such as Axel Springer, from which our pre-seed VC APX and now also Heartfelt Capital in Berlin emerged. And we also invested in a selective number of venture capital funds worldwide, such as Headline VC from Berlin and San Francisco, as another example, in addition to our own direct investment activities at Porsche Ventures.
Yeah, thanks a lot for these first insights. We will touch upon one or the other topics of your answer shortly. Talking about Heartfelt, Jörg, building upon Patrick's response about continuously learning and also the mix of people that are involved regarding their capabilities, could you please tell us more about APX and why acceleration programs can be a good starting point to experiment with CVC activities?
Yeah, happy to. First, I need to make a bad joke, because how can you do something with Porsche without acceleration? This is impossible. So when we started to talk to each other, we had learned quite a bit already about how you can work with very early stage founders. And I think that's also something that Patrick mentioned. As a CVC, I think you need to look at all the different stages and areas and how you want to interact with startups at different stages. And we always focus on the very early stage. And when actually Louise, I, and others started Axel Springer Plug and Play long ago, our initial idea was that we should create something that is so close and yet so far from the corporate that allows the founders to grow their ideas or their dreams, basically, or depending on how romantic you are, from an idea stage to the next level where you see the first traction and then develop on the venture path. And I think when we started in the beginning, we organized it a bit like a school and learned quite fast that we need to be more individual. So when you look at what we do today with the founders we invest in, it's we select them, then we invest like a normal VC, and then we see how we can help them take their ideas to the next levels. And what differentiates us in an ideal case or scenario from other investors is that we just have more shortcuts that we can offer. Like having time with, for example, the people on this panel can be extremely helpful for early stage founders. Getting doors opened in testing ideas with our corporate investors for the ideas that the startups have can be extremely important shortcuts in their path to success.
Yeah, thank you for this insight. I think we now have learned a bit how to kick off CVC activities and what it takes to, and how the team should look like, and how the interface to startup should look like. So now let's get one step further. So assuming the decision in favor of CVC has been made, and we are now moving into the operational planning phase. Louise, what are the critical considerations from a governance perspective?
Yeah, so normally I would say you have two extremes in the CVC units. Yeah, you have first the first starting point is often the more opportunistic, more ad hoc direct investment. Yeah, and the other extreme is the near independent single investor fund. Yeah, with a separate legal entity. Yeah, but and one of the main difference is the level of autonomy between them. Yeah. But the vast majority of CVC units is in between, and they have no independent entity, and they are part of a larger corporation, and they invest from the balance sheet. Yeah, and this can create conflicts between the goal of the corporate and the goal of the CVC unit. Yeah, and therefore it's totally important that the CVC unit has a clear governance structure. Yeah, with certain degree of independence, which allows the CVC to operate independently and establish a very efficient approval process that investment opportunities can quickly be done. Yeah.
Yeah, that's pretty interesting. Jihan, this resonates, I think, pretty well with your findings as part of your MBA thesis, where you talked to, I think it was roughly 60 CVCs in Germany. What are other design parameters, apart from what Louise has just said, that need to be thought through? So, such as what functions, roles are mandatory? Do geographical considerations play a role, etc., etc.?
Thank you, Mark, and also thank you, Louise, for going into that direction. During my interviews with really CVCs from very small businesses, with corporates, but also huge, large organizations, I basically figured out, let's say, 5 key indicators, design parameters for CVCs. The first one was the rationale, right? So making the decision of a CVC is the one hand side, but on the other hand side, you need to define the overall goal. Is this CVC financial driven, or is this CVC strategic driven? If it's strategic driven, it needs to be very close bounded to the strategy of that very corporate. If it's financial driven, it's very free floating, right? And then it's not black and white. We have several dimensions of how this rationale then can be designed through. You can have it strategic with some financial goals. You can have it fully financial with some strategic. That will be the first one. The second one is the legal setup. As also Louise said, you have very different dimensions of building up the CVC. You can have a fully owned legal entity being very separate, the famous speedboat out there very far away from the corporate, but you can have it also just as a department in the finance resort, for example, or in the corporate development department. This brings several other indications with it. If you have a separate entity, it's something different than having it internal. The third thing was business owner. You definitely need to answer the question if this CVC, if it comes with an investment, with a startup, that very startup need a business owner in that corporate, yes or no? If you do not answer that question, you would have some who would have a business owner, some without, and then will be the question, what incentive would that business owner have in that corporate to support the CVC and support this very startup? It could be in the overall goal for the corporate something very interesting, but it would not rescue the day of that very business owner that is doing whatever operational stuff, right? So you need to answer that. Fourth was the incentive model.
Working in a venture capital environment brings you an incentive model that is something very unique, which you do not have in industries. But if you want to now do VC in corporates, then you have the point again. You need to decide, do I do the incentive model what you have in that industry, or do I do the incentive model, incentive scheme, which I have in my industry anyhow? And that, maybe we can come on that later on again, is a critical point in the very development of that CVC. And last but not least, decision process. Usually coming from VCs, they have very fast decision processes, right? So they decide, the business owner, or let's say the general director, whomever, decides to invest in a startup and they go ahead. What decision, let's say, freedom would you give your CVC? Does it decide on its own and just invest? Or does it need to go back to the headquarters and ask, I don't know, in several rounds for permission? Meanwhile, the investment has gone away already, and then you cannot be very successful if you do take too much time. So these 5 key parameters were coming out during my interviews, and I think this brings it down to the point of the criteria you need to think about.
So thanks a lot, Gian. This brings us actually to the next topic, and some of the aspects we will touch again and maybe deepen a little bit. Thank you very much for the vivid discussion so far. And now I'd like to move on with the second topic, focusing on the benefits and challenges of corporate venture capital. Since Gian looked deeply into the development of CVC units over time, as we have heard, directly connecting to what you just said, looking at the development of a fund, how do the goals of the CVC units change over time, and what organizational challenges does that bring along?
So usually most of the CVCs I interviewed start strategic driven. No industry corporate starts building up a financial vehicle to do financial investments just for the sake of doing financial investments, right? So usually you come with a strategic outlook and say, okay, I want to enhance my innovation process in my corporate. I want to bring in innovations from outside with the speedboat, with a different vehicle than classic innovation vehicles, yeah, and want to bring it to the core of my business. So you start strategic driven. Over time, and this is what the community brings with it, this is what the processes, the bubble, let's say, overall, the venture capital startup, all these topics bring with it, is that at the end, you are at the cap table of a startup and betting for getting a ticket to invest into that startup, right? And this startup has choices. It goes either with the classic VC that brings money and maybe some other incentives, or goes with the CVC that brings money and other CVC that corporate related incentives, right? Mm-hmm. And over time, the strategic outlook of that CVC changes from being strategic driven, that the people in that CVC see how, let's say, others are being incentivized, other VC players, for example, being incentivized, and want to have as well this financial driven and financial incentive schemes. So naming it directly, to have a carry is something that is very normal out there in the VC scene, right? So for the value you created, above a several line, you are being participated in that value creation, which is, let's say, for someone who is not invested, something very unusual out there in other industries. And now in the CVC, you have a standard contract, let's say, you have a standard compensation scheme. You now start raising that point of saying, okay, I'm still strategic, but I want to have a financial driven governance as well. So I want to be free in my decisions, and I want to be incentivized with other schemes than you are used to. And that, as you can imagine, brings really huge differentiation and a huge challenge with it. But there are CVCs out there who have gone that way. They started very classic strategic driven, have been very successful with that. And then it developed into something like a VC only. So that C got in brackets, but that corporate was the anchor LP and could participate and also consume the very positive development of that very CVC.
Yeah, but looping in Patrick again and building on what Cihan elaborated and bring that back to Porsche and about the development of the fund. So in April, we read and internally heard that you are going to Luxembourg with the fund, and that the organizational form is also changing. So could you shed light on the typical development stages of a large fund and share some milestones from the development of Porsche Ventures?
Yeah, sure. So first of all, I think Cihan is perfectly right that the development of many CVCs is also a certain evolution over time. I would say in our case, based on the success of our first fund generation of Porsche Ventures, we are now shifting into the next gear with our second fund generation in order to become even faster and more agile when it comes to investment opportunities. So as part of this process, you mentioned it, Mark, we just opened up a new office in Luxembourg alongside our established international locations in Palo Alto, Berlin, Tel Aviv, and Shanghai. But I would say, in general, as investors in the technology sector, we move at high speed and are constantly changing. That's why it's not so much that there were specific milestones or developments, but rather the continuous development of us as an investor based on a very dynamic market environment in the area of venture capital and technology.
If you honestly and self-critically reflect, what were the key lessons learned along the way, and maybe you would have done something differently in perspective?
Yeah, a great question, and I think after a couple of years now in the venture capital business, if I would need to break it down to the three main lessons learned that we made over time, I think first of all, diversification is key. So you need to diversify your portfolio across various sectors, industries, stages, and also geographies to some extent, based on your overall investment strategy, as this really helps mitigate risks and increases the chances of finding and investing in successful founders and startups. So that's one, diversification. The second one, and I think Cihan also mentioned it before, of course, you need to have a long-term perspective. So unlike traditional venture capital funds, CVCs typically have a longer investment horizon. And in general, investing in startups is a long-term play. So you need to be patient as an investor. You need to understand that the innovation and the technology you invest in may take several years to mature and become relevant for your corporate. So that's the long-term perspective. And the third one, I would say, is definitely strategic alignment. So as a CVC, you need to make sure that the investments that you do to a certain extent align with the strategic goals and the interests of the parent company, especially if you have the corporate as the only and sole investor in your fund. So I think, therefore, it's very crucial to have a clear understanding of how this specific startup or its technology fits or product fits into the overall corporate strategy in that regard. So diversification, long-term perspective, and strategic alignment.
Yeah. Fully agree on that. What we observe from our side as well. Let's stay with the discussion around the development of a corporate venture, and maybe building on what Gian and Patrick was mentioning. Jörg, as time goes on, the knowledge transfer between corporate and startup also plays an increasingly important role, as we have also heard in the beginning. Perhaps also from your role at Balzen, what challenges are common, and what recommendations do you have for the audience?
Yeah, thank you. So I think a very important thing to note is that it's humans who need to talk to humans. I think that's the most important thing when you want to have founders and corporate people work together. The knowledge transfer and everything will only happen if you can connect humans to the right humans. And then it's continuous learning on multiple dimensions that you need to do. And one very important dimension is the understanding of different realities. And this sounds very, very abstract. But one example, for example, is when you, in most corporates, innovation is an incremental process where you have a lot of data that will tell you, okay, this could be the next step that we go. When you talk to an early stage founder, they usually have nothing, and they just have hypotheses or hopes, and then they need to create the reality step by step. And this doesn't matter if it's like a car manufacturer, a media company, or someone who makes cookies. Alone, the fact alone of getting these people together in a room, people who are used to having a lot of data and making decisions based on that, and people who have a lot of ideas and who turn them into reality in a very fast speed. This is super inspiring for everyone, because everyone will long to get to the point where the other one is. It's a very interesting discussion that I've luckily had the chance to be part of multiple times. So that's one way to look at it. And then two examples from the Balzen world is they have one brand, Rawbite. They do like fitness things that you can eat, and they are just a very small organization in Denmark, and they can be just so much quicker than the large organization, and they just talk to each other. That's important to just see how fast you can be, but also the Rawbite people can learn like how can we make our like cookie production or bar production better. And then another example is the Balzen family started something called TED-VC, where they invest in the future of food. So they have invested in companies in the US that try to replace sugar with fermentation processes. If that works, that will have quite a large impact on how baked sweet snacking is going to be. And the indulgence will still be there, but maybe the bad conscience will go away. Let's see where this goes. So, and I think it's always, you have to do this along the whole chain of like super radical innovation to incremental innovation and make people talk to each other.
Yeah, you added the human factor to the game. This is also 100% Porsche conviction on top of what Patrick has mentioned. So also here 100% agreement. And bringing Louisa back again, and you've negotiated many deals as well, and also have frequent exchange with other founders. Could you please take us on a journey of what the collaboration between startup and corporate investors looks like from your perspective, from your observation, from your experiences, and what are topics that are usually discussed jointly, and what are the expectations of the founders that might deviate from the CVC?
Yeah, so I think every CVC does it different, yeah, and normally expectations are aligned before we invest, and as we have a huge founder network, the founders speak to each other, yeah. So as we usually invest very early, I think Jörg touched on it at the beginning, our corporate collaboration is a lot about guidance, mentorship, test pilots we do, yeah, the access to our international network, to the right decision makers, yeah. during our investment phase, so to say, we try to create as many opportunities as possible, yeah, and we do the intros, and normally the startups have to take it from there, yeah. So we, as a CVC unit, I would say, usually have it starts with a month or a quarterly a call, yeah. But the business units itself, of course, can have a lot more touch points, yeah, that can be on a daily basis.
Yeah, now we have learned what are considerations at the beginning of founding a CVC entity, how it evolves over time, what are challenges to overcome, but also key success factors. I think it's a good moment to move on to the third topic of our today's discussion. Before I do that, just a little reminder to our participants at the screens, if you have any specific questions that we haven't answered here regarding those two intro topics yet, so please post them in the chat and we'll do it. We will try to answer as quick as possible. So that being said, let's move on to question cluster number 3. Now looking into the future of corporate venture and starting with you, Luis, would like to pass on the first question to you. So are corporate investors in the eyes of the startups getting more attractive over the last 2 to 3 years? And we have heard the difference of strategic versus financially different. So purely financially driven investors had to dump investment during the COVID pandemic. Corporate investors proved to act with as we have also learned, with a pretty long-term perspective.
Yes, true. Yeah, I want to underline this. The answer is yes, and I want to underline this fact by two numbers. Yeah, in 2020, corporate-backed deals, yeah, have accounted for 19% of global VC funding versus only 11% a decade ago. Yeah. And also the overall fund VC investment 2020 to 21 declined with normal VCs by 25% and only by 2% by CVC investors. Yeah, so these numbers show that CVCs are a lot more active and invest. Yeah, and I think startups more and more realize that the industry knowledge of CVC gives us additional value, yeah, and because CVCs can add, as we already said, next to the network, they can add further clients, they give revenue opportunities, yeah, and that is also very often also a trust stamp, yeah, that other investors see, yeah.
So positive market developments regarding CVC. Jörg, how do you see the future of corporate venture capital from your experience, from your perspective? Will evaluations remain at relatively low levels, at least here in Central Europe, or does the trend continue that CVC capital is also becoming more and more attractive?
So I think it's the valuation growth still makes total sense to invest in early stage startups. I think it's different now if you would want to start a later stage fund and you would have to deal with all the like diminished valuations that you see in late stage companies. So I think for early stage investing, it makes total sense to invest. I think also that founders will always start companies, and the companies they start today are built to be successful in the environment that we have today. So I think it makes absolute sense to continue to invest in early stage, because all the positive things you can do together that we talked about before, they still exist, and they are very important for everyone to learn. Great opportunities.
Yeah, you and the other panelists are kind of representatives of larger companies. So that made CVC investment. Will we see more CVC activities of medium-sized companies in the future?
I do hope so. What we see today with Hartfeld, which is interesting, is that quite a lot of our LPs are shareholders of Mittelstands companies. And they say, I don't know if my company is ready yet to do an investment into a venture capital fund, so a classic CVC investment. But I know that I, the owner of this company, really like the asset class of early stage venture investment. And we have quite a lot of discussions with them how it can be possible for their organizations to connect with some of the startups in case the organization is ready. And I think this is quite a sign of grown-upness. I don't know if this word really exists on their end, that they say we really think there's an opportunity. We don't know yet if the operational entity of the company is ready yet for that, but the owners of the company already invest in venture capital as an asset class that they like, but they totally see that there's synergies to be had. And I think this will be a period, and then Mittelstand will have figured out how important it is to interact with young companies on levels that they don't know yet, or that they know yet, but they haven't done yet.
Yeah. Thank you, Jörg. Cihan, also now coming back to your many interviews with different sets of CVCs of different size and owned by companies of medium-sized companies, but also larger ones. So, in which industries do you see opportunities for these potentially new players embarking on the CVC train?
So to be honest, basically every industry, I would say, that is somehow facing challenges in market environments and therefore need to be innovative, I would say. And coming with such a broad definition, I think the amount and also the spread is very large. So basically every company that is somehow facing challenges and need to come up with innovations should think about in that, let's say, in that frame of innovation tools, also about CVCs. Let me give you maybe 3 reasons why that would be something different than anything else in that innovation landscape. Reason 1 would be, in best case, even if you do not get very successful. I mean, if you are very successful, then this is exploding, and an investment you made brings you the new Uber or whatever, right? And then everything paid off. But even if it does not, in the worst case, you have an innovation unit that pays for itself. You invest money in it, things happen in that entity, in your entity, people exchange, you have some communications, you have some marketing, you are on the plate, you also get cultural, let's say, influence. And at some point, you sell the shares or you develop, and it paid for itself. So show me any other innovation unit that pays for itself without such a high risk. That is one thing. The second thing is, one interviewee I had said that he, as the CVC owner in that company, feels like a competitor of the local R&D department. And I think this was also something very interesting. He said, I got one competition. I'm not in competition with other CVCs, with other VCs, whatever. My competition is the internal R&D department. And this is a sweet competition, right? So they are in one, let's say, group, but the one is working with the classic tools in that group. The other one also working on the same problems, by the way, but with totally other tools, with totally other environments. Why not trying this out if you are healthy enough to carry that, right? And last but not least, another interviewee said that his goal with his CVC was to build a new business unit down the road with the CVC. He said, what I want to do is not to invest in, let's say, the next Facebook or the next whatever, right? So not that part of the startup game, but eventually coming with something that could be down the road a new business unit in that corporate, and that again, diversifying your business. So we are not talking about something very far away from your core. I think when you're discussing that, most of the people have in mind, oh, I'm doing my industry here, and this is very hard, and I don't got time to do CVC. This is hocus pocus down there. This is nothing for me. This is what people sometimes think. But what I experienced with more than 50 interviews was that people say, I have the chance to build a new unit, to pick that out there in the street and find a new way to diversify my business, to bring in a new asset class, to bring innovation, and to really with the okay amount of risk to bring really interesting reward with it. And that, I would say, comes then to the point of basically interesting for everyone who is doing innovation.
If there's a kind of internal competition between the CVC and the internal R&D, what is the punchline or the argumentation line when both units speak to each other? And how does the new vehicle, the CVC, encounters that he adds value and doesn't take away the internal innovation?
Very, very good question, Mark. Thank you very much. And what I experienced there was that the rules and the strategy, the tone from top needs to be very clear. If this is something shady, there is a unit out there, they do what they want and this and that, then this doesn't work out. If the externals can spend money they like how they want, and the internals need to find for every euro, this doesn't work as well. You need to have same, let's say, starting principles, same requirements for both of them, for both, let's say, units, areas, departments, right? And only then you can go with them. And as I said, this is not a hard competition; it's a sweet competition, right? And it enlarges, let's say, the cake, and it's also at the end, it's positive for both of them. And very important, as I said, is that the rules are clear, that the collaboration principles are clear, business owner, what they need. And at the end, you have competing departments. It's not everything very clear. This is also something classic in corporations, right? So with huge organizations, you have people somewhere where the one is doing A and the other is doing A as well, but they don't know from each other. And this is something that happens not on purpose. But if you build it on purpose as an innovation vehicle, then you are in the driver's seat. Then you define what comes out there, and then you define what the roles are. So I would say, give it a try. Why not?
Yeah, I think that's a perfect pass to Patrick. Christopher mentioned in his speech in the beginning that there is a kind of orchestration of the different innovation vehicles relevant for corporate venture, internal acceleration program, R&D, etc. Patrick, can you share some insight how this is done at Porsche and what conflicts, but also which opportunities, which is more in the forefront, arise from that or have arisen?
Yeah, I think to be fairly honest to the audience, there's certainly no innovation silver bullet that suits every company. I think that's very clear. For us at Porsche, it has always been important that we approach the topic of innovation with a diversified toolbox, as Cian mentioned as well, in terms of both different topics, but also different approaches. So I kind of like shared before, we of course do our own venture capital investments as Porsche Ventures. At the same time, we started pre-seed funds like APX together with Axel Springer. And we invest in venture capital funds like now Hartfeld Capital from Jörg and Henrik in Berlin, but also Headline. So I think again here diversification is key. in order to achieve the individual goals of every company. And then on the other side, I think it's also about the human factor. Do good and talk about it. And by that, I don't mean externally talking about it only in terms of external communication, but also internally. So you need to be transparent and share every innovation project and investment that you do very transparently with the whole organization to get every employee on this journey of innovation. This is at least our strategy at Porsche, and has been our strategy at Porsche in order to bring everyone on board with the different vehicles and tools that we use.
Yeah, thanks a lot, Patrick. I think all of you provided now a kind of 360-degree view from a higher level perspective already. Surely we cannot cover everything in 50 minutes so far. But let me conclude our panel discussion today. And therefore, I would like to ask all of you for a last statement. So could you please complete the following sentence with your personal statement? The single most important factor to build and run a successful corporate venture capital unit is, Patrick, maybe start with you.
I keep it short. Long-term value creation.
Jörg?
I have two. I want us to continuously define, refine, execute what success looks like in the most important dimensions, and to have the time and resources to get there. That's the long answer. The other answer is very much like Patrick's. Buy the shares of the companies much cheaper than you sell them for later.
Yeah.
Oh, right.
True. Your perspective, Louise.
I would say the right governance.
And lastly, yeah.
I would like to add on to Louise's point of the right governance, build a sweet competition between your internal units and your external CVC unit to really be in a fruitful development of that one innovation tool, one of others, right? And orchestrate the whole orchestra of innovations with one specific speedboat such as your CVC.
Yeah, thank you very much to all of you for sharing your insights. Highly appreciated. Let me continue with the closing of today's virtual roundtable. The key question in the beginning, remember, of this roundtable was corporate venture capital. Does it pay off? The keynote already provided robust evidence that it was a good move to not only for Porsche but for many other companies. If you are new to the CVC game, we've heard many actionable insights to get started, like investments in already existing funds to build a network and necessary investment competencies. Another key factors we have learned is that become evident is that CVC is not a vehicle for fast measurable results. It's a long-term play, and the realistic judgment of the roadblocks ahead, such as the sometimes occurring knowledge gaps between startup and corporate. And the discussion concerning the market condition revealed that we have promising market conditions currently for startup investments, and that also mid-sized companies are increasingly active. If not, they should, as Gian kind of, if I rephrase you, kind of said. To sum it up, corporate venture capital is a proven vehicle to increase your innovation capabilities despite all the complexities. And in that sense, I hope that everyone in the call could get good insights, and you were able to retrieve some value out of it. Again, many thanks to our panelists, Luisa, Patrick, Cihan, Jörg, and Christopher, for sharing your knowledge, experience, and insights so openly with everyone tonight. Thank you again to the audience. I wish you a great evening and see you soon. Bye-bye.